For decades, Kohl's was one of America's most trusted retail names. With over 1,100 stores, valuable properties, millions of customers, and a strong reputation, it looked like a company that could handle any challenge. But what happens when a successful business starts making difficult decisions? How does a retail giant with so many resources begin to struggle? Over the years, Kohl's faced major challenges, including rejected takeover offers, falling stock value, credit rating problems, store closures, and leadership changes. But how did a company that once seemed unstoppable reach this uncertain position? In today's episode of Collapse Files, we'll uncover the rise, struggles, and decisions that changed Kohl's future. Before we begin, make sure to like this video and subscribe to Collapse Files for more stories about the biggest business successes, failures, and unexpected corporate battles. Now, let's discover what really happened to Kohl's. A small grocery store becomes a retail empire. The story of Kohl's began with Max Kohl, a Polish immigrant who started a small grocery store in Milwaukee, Wisconsin, in 1927. Like many successful businesses, it started with a simple idea: provide customers with reliable products and good service. Over time, that small grocery store grew into one of the largest grocery chains in Wisconsin. This success gave the Kohl family the confidence to explore a new business opportunity. In 1962, Max Kohl's sons opened the first Kohl's department store in Brookfield, Wisconsin. Instead of following the traditional model of building stores inside shopping malls, they created standalone stores near busy roads where customers could easily park and shop. Kohl's focused on offering good quality products at affordable prices, placing itself between expensive department stores and low-cost discount retailers. This smart approach helped build the foundation for Kohl's early growth. Growth across America. In 1972, the Kohl family sold the company to Batus, the American division of British American Tobacco. For a while, Kohl's continued growing under new ownership without major changes. A major turning point came in 1986 when a group of Kohl's managers bought the company through a leveraged buyout. They used borrowed money to purchase the business and focused on expanding its future. In 1992, Kohl's became a publicly traded company, which helped provide the funds needed for major growth. During the 1990s and early 2000s, the company became one of America's fastest-growing retailers. Kohl's opened stores in suburban areas instead of costly shopping malls. It attracted customers with popular brands, affordable private label products, coupons, and frequent sales. By the late 2000s, Kohl's had grown to more than 1,100 stores and joined the S&P 500 index. The company appeared stronger than ever. The retail world changes. The retail world was changing quickly, and Kohl's began facing new challenges. Online shopping became more popular every year, Amazon grew into a major competitor, and many customers started buying products without visiting physical stores. Although Kohl's stores were mostly located outside shopping malls, the company still felt pressure from the rise of online shopping and changing customer habits. To attract more shoppers, Kohl's tried different strategies. The company introduced clothing collections with well-known names like Vera Wang, Lauren Conrad, and Jennifer Lopez. It also partnered with Amazon, allowing customers to return Amazon purchases at Kohl's locations. Later, Kohl's worked with Sephora to bring beauty sections into many of its stores, hoping to attract more customers. These partnerships helped increase store visits, but they could not completely fix Kohl's larger problems. Sales became harder to predict, and competition in retail continued to grow. Valuable real estate, growing pressure. By 2022, Kohl's still looked like a strong company from the outside. It operated around 170 stores, employed thousands of people, and continued generating billions of dollars in annual sales. One of Kohl's biggest strengths was its real estate. Unlike many retailers that rented most of their locations, Kohl's owned many of its store properties. These valuable assets made some investors believe the company had significant financial options. One possible strategy was a sale-leaseback, where a company sells its properties and then rents them back. This can provide quick cash, but it also creates long-term rental payments. As Kohl's faced more challenges, investors started paying closer attention to the company's decisions. Many began asking an important question: was Kohl's leadership making the right choices to protect the company's future? Billion-dollar takeover offers. In early 2022, Kohls found itself at the center of a major takeover battle. Several companies believed the retailer had more value than its stock price showed. Acacia Research, backed by activist investor Starboard Value, made an offer of about $64 per share, which valued Kohls at nearly $9 billion. Private equity firm Sycamore Partners also showed interest with a similar proposal. Many shareholders supported these offers because they were much higher than Kohls' market price at the time. They believed a sale could provide them with a strong return. However, Kohls' board disagreed and decided that the company was worth more. To protect itself from a possible hostile takeover, Kohls adopted a poison pill plan. Supporters said this gave the company time to find the best option, while critics argued it limited shareholders from accepting attractive offers. The sale process fails. After rejecting the first takeover offers, Kohls decided to explore whether selling the company could be the right move. The company began a review process, and more than 25 potential buyers were given the chance to study its business details. One serious bidder was Franchise Group, which initially offered around $60 per share. However, the business environment started changing quickly. Interest rates were rising, making large deals more expensive. Since many private equity firms use borrowed money to complete acquisitions, higher borrowing costs made buying Kohls more difficult. Franchise Group later reduced its offer to about $53 per share. After reviewing the situation, Kohls ended the sale discussions, saying market conditions had become too challenging. The decision became a major topic of debate because Kohls' stock price later remained much lower than the offers the company had received during the takeover talks. Cash problems and strategic decisions. After the takeover talks ended, Kohls continued to face pressure from investors who wanted the company to improve its performance and increase shareholder value. One major decision was the company's stock buyback program. Kohls approved a $500 million accelerated share repurchase and also announced a larger $3 billion share repurchase authorization. Stock buybacks can sometimes benefit shareholders because they reduce the number of shares available, which may improve earnings per share. However, buybacks also require a large amount of cash. That money cannot be used for other important areas, such as improving stores, paying down debt, or investing in future growth. As Kohls' challenges continued, some analysts questioned whether saving more cash would have been a better choice for the company's long-term stability. Leadership problems. Kohls' problems were not only about money and sales. The company also faced uncertainty at the leadership level. In late 2022, CEO Michelle Gass announced that she was leaving Kohls to become the CEO of Levi Strauss & Co. After her departure, Tom Kingsbury stepped in as CEO during a difficult time when the company was dealing with weaker sales, investor concerns, and major business challenges. In 2025, Ashley Buchanan became Kohls' new CEO, but his time leading the company was very short. After an internal investigation, Kohls removed Buchanan after finding that he had violated company policies related to an undisclosed relationship involving a vendor connected to the company. Following his removal, Michael Bender was appointed interim CEO. These frequent leadership changes created more uncertainty and raised concerns among investors, employees, and customers about Kohls' future direction. Credit ratings declined. As Kohls' financial challenges continued, credit rating agencies started paying closer attention to the company's situation. Concerns grew as the retailer faced pressure from weaker performance, changing customer habits, and a difficult retail environment. S&P Global Ratings and Fitch Ratings later lowered Kohls' credit rating to below investment grade, showing that they viewed the company as a higher financial risk. But what does this mean for a business? A lower credit rating can make it more expensive for a company to borrow money because lenders usually charge higher interest rates when they believe there is more risk involved. For Kohls, this created another challenge. The company was already dealing with strong competition and changing shopping trends, and higher borrowing costs made it even harder to improve its financial position and invest in future growth. Store closures. As Kohls continued working to improve its business, the company made difficult decisions to reduce costs and operate more efficiently. In 2025, Kohls announced plans to close 27 underperforming stores along with one distribution facility in San Bernardino, California, These locations were selected as part of the company's effort to focus on stronger stores and better manage its resources. Store closures are never easy because they affect employees, customers, and local communities. However, for Kohls, these changes were part of a larger plan to adjust to changing shopping habits and create a stronger future for the company. Lessons from Kohl's decline. The story of Kohls teaches several important lessons about running a successful business. First, having valuable assets does not always guarantee success. A company may own billions of dollars in property, but if customer habits change and the business does not adapt, those assets alone cannot solve the problem. Second, timing plays a major role in business decisions. Turning down takeover offers can become a difficult choice if the company's future performance does not improve as expected. Third, strong leadership is extremely important. Frequent changes at the top can create uncertainty and reduce confidence among investors, employees, and customers. Finally, credit rating problems often do not appear suddenly. They usually reflect deeper challenges that have been developing over time. Kohl's experience shows that businesses must make smart decisions, adapt quickly, and plan carefully for the future. Kohl's journey is a reminder that even the biggest companies can face unexpected challenges. Its struggles were not caused by just one mistake, but by years of changing shopping habits, growing online competition, financial pressure, leadership changes, and difficult business decisions. But what can we learn from Kohl's story? Can a company with a strong brand and valuable assets still lose its way if it fails to adapt? Kohl's is still an important name in American retail, but its experience shows that success is never guaranteed. Companies must continue changing, improving, and making the right choices to stay competitive. If you enjoyed this story, don't forget to like this video and subscribe to Collapse Files for more fascinating stories about business successes, failures, and the decisions that shape the future of major companies. Thanks for watching, and we'll see you in the next episode.